State of the multifamily market, March 2025. Hey everyone, welcome to this week's video. We're going to take a bit of a macro dive into the multifamily market this week and talk about where we are in March of 2025, what the rest of the year potentially has in store for multifamily apartment buildings, and what's happened in the past few months that could alter the trajectory of where we're heading in multifamily. So the first one we want to get into is obvious one, interest rates. There was a saying, there's survive till 25 was a saying. We don't have that anymore. If you're not familiar with the phrase, effectively, a lot of investors who may have been in assets that were in distress or struggling, their motto was survive till 25 when interest rates were expected to come down. Now, we've been saying interest rates are going to be coming down for a couple of years now, and it hasn't eventuated. And not only has it not eventuated, but in the past few months, the Fed has actually said that they're expecting interest rates to remain higher for longer. So coming into this year, we're expecting 4 interest rate cuts in 2025. That was already lower than we were expecting. We were expecting multiple drops in 2024 and even more in 2025. But that is no longer the case now. There's currently about 2 interest rates priced in, and who even knows if that will eventuate. So what does this mean? It means that those who are waiting for 2025 to potentially refinance into lower rate debt may have their hands forced into either selling at a discounted price or having to raise more capital for their projects so that they don't go into default. So that's going to be something to watch for sure in the coming months. And I always like to say when it comes to interest rates, perception of where interest rates are heading are just as important as where the actual interest rates are. So you could imagine if in 2022, when the Fed started raising interest rates, if they would have said from the outset, we're not going to be dropping rates by any meaningful way until 2026, 2027, then you would have conceivably have a vastly different market. A lot of those speculators, people thinking that interest rates were always going to drop in the next 6 months, 12 months, their underwriting would have completely changed and they may have not done deals, and we might have actually seen more of a dip in the market earlier. Instead, with everyone thinking that an interest rate drop, a significant interest rate drop is imminent, people were still paying those 2022 prices that were frankly ludicrous in some cases. So the perception of interest rates and where they're heading is just as important as the actual interest rate number. So always keep that in mind. The next one we have is transaction volume. So transaction standoff continues is the title here. And transactions were actually up 64% in the last quarter of 2024 over 2023. And a lot of people looked at that as saying, hey, this is a great sign, it's rebounding. But the truth is the levels were very low in 2023 for transactions as we were going through that higher interest rate, the highest interest rate period. But also these transactions are kind of they're large scale transactions that have somewhat inflated the transaction volume that's been going on in the past quarter. So you have to look at it as a whole. And right now, the transaction standoff still continues. So sellers and buyers don't generally have a good overlap of what the buyers are willing to pay and what the sellers are willing to sell for. In fact, what you'll see, especially in the mid-market range, is that a lot of sellers are pulling their properties from the market instead of selling at a discount. They're actually pulling their properties from the market, looking to increase the value by raising rents and then hopefully sell it back, put it back on the market at a later date once they can hit their numbers. So it kind of increases the um, or I should say, decreases the supply in the market. And a lot of people are reading into various different metrics and things, but ultimately, we're still in a kind of a transaction standoff, and we see that continuing at least for the next few months, if not towards the end of the year. So, something to watch out for. Something that relates closely is new construction supply, which is down. Last year had a record number of deliveries, 530,000 new multifamilies. Now, remember, construction and development is a knock-on effect. A lot of these that were delivered last year probably didn't break ground until the previous year, 2023, probably weren't even planned until 2022 or 2021 when we were at the peak of the market. So a lot of this supply could be struggling to get filled. And right now, as of 2024, there'd only been 230,000 new projects that had broken ground. So that's nearly, it is less than half of what was delivered in 2024. So going, looking forward for this year, assuming these all get delivered, we're looking at about 230,000 units, which is very low. The reason being is that multifamily projects just don't pencil out in most parts of the country now. Construction costs have gone up significantly over the past couple of years, and interest rates are also still high. So it's making the numbers not pencil out, meaning that construction is definitely dwindling, at least for the new product is concerned. The last point we have here is the wild card, which is the Trump administration moves. What is the Trump administration going to do? Well, we have an idea of what they're going to do, but how it will actually affect the multifamily market remains to be seen. I mean, housing is such a huge part of our economy, so any slight changes in fiscal policy in other areas could have a either minor or dramatic impact on the multifamily market. And anyone who says they know exactly what's going to happen is lying. No one really knows. We know what the intentions are. A couple of areas where it could definitely be effective are the tariffs. No one really knows what the net effect of the tariffs will be. And mass deportations. Mass deportations have not happened in this country really ever. And so the effects on the labor force, demand on housing, and a lot of it depends on the extent that these mass deportations occur. They could have almost none to a little bit of effect, or it could have a dramatic effect on the demand for housing, and then also the supply on the construction side. And then, of course, we have tax cuts, which can always impact the economy and housing and multifamily. So many factors at play here. It's hard to know exactly the what effect they will have and the extent to that effect. So that's all we have time for this week. Those are the things to look out for. It looks like we're going to have a lot more of the same in 2025, but there are these wildcard moves that could really upend everything we've talked about today. It really comes down to which of these points is going to have the biggest impact in multifamily in 2025. So thanks for watching, and we'll see you next week.